Good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we have a pretty special webinar on trading credit spreads. This is a very versatile strategy that we have certainly put a lot of resources into better understanding over the last few months with our quant resources. It's a strategy that really allows you to generate income in all different types of market outlooks and conditions. It's extremely forgiving strategy. For those of you that are relatively new to trading, this is a bit of a more advanced strategy in my opinion for most users. So if you're brand new to trading credit spreads, I'm hopefully going to break down this strategy for you so that you understand the structure of this strategy and understand what is the right strategy to compare it against, because I do get a lot of questions asking me, do I prefer trading credit spreads or debit spreads? In reality, these two trades are very, very different. So especially for those of you that are still learning, I encourage you to take a look at the debit spread webinar that we did last week if you want to learn more about that strategy. And today we're going to cover credit spreads. Now, if you've already traded this type of strategy, what I really hope to provide you with is a deeper understanding of this specific strategy. Understand based on our back testing, what type of optimization or what type of strikes are most important and what things should you be looking out for when you're trading this strategy. Now, like I said, we've over the last 6 months put a considerable amount of quantitative resources into exploring this strategy. Everything from generating high quality trade signals to start selling credit spreads to figuring out what is the optimal credit spread to sell once you have that valid trade signal. So what I want to show you guys also is the outcome of all of that work that we've created. We launched Options Play credit spread signals about 6 months ago, and we've continuously optimized it over this period of time. And we have an offer for you guys on this webinar to show you how to access some of the quantitative signals that we've generated using our quant resources. So today, the webinar will be recorded and the slides will be available to everyone afterwards. But like I said, we do have a pretty special offer for everyone here on the webinar here today. So just to get started here, for those of you that are brand new to options trading, welcome. This webinar is designed to really help anyone who's a beginner or advanced trader better understand credit spreads. But Options Play also offers our own credit spread trading signals. And you can sign up for a free 7-day trial to this credit spread trading signal. Currently, membership is only $39 a month, but as part of this webinar exclusive, we're giving everyone a 20% discount code after that first 7 days, 20% off using this discount code OPS20 off for those of you that are interested. And we're going to come back to this at the end of the webinar so that first, we want to make sure that everyone understands what credit spreads are, how to go about trading them before evaluating whether a trading signal like what we provide is suitable for you. And this provides daily trading signals delivered to you intraday, either by email or phone notification. So we're going to come back to this at the end of the webinar to show you what we have to offer. In the meantime, what I want to talk about is really diving into credit spreads as a trading strategy. A lot of you tend to like to trade this strategy. So first of all, what I want to help define is what are credit spreads. And the reason I want to do this is because I really want to break down a credit spread. It's not just the inverse of a debit spread. So I want to talk through why you should consider trading credit spreads, but more importantly, when should you trade credit spreads? Because that's a really big differentiator between trading credit spreads versus debit spreads is actually when you initiate these positions. And I want to make sure everyone understands what are the optimal conditions to sell credit spreads, and based on our quantitative backtesting and research, what we've discovered. And then I want to go into, once you've figured out when to trade credit spreads, what credit spreads do you actually trade? So we went through optimization of credit spreads, all different types of expirations and strike prices, and what we've discovered is a pretty clear indication as to what is the optimal credit spread. And then lastly, how do you actually manage those trades effectively? We've tried all different types of take profit, cut loss strategies, and we wanted to share with you our data as to where we just based on our data, what is the best way to go about managing these types of trades. And lastly, what I'll do is I'll talk a little bit about how we derive our credit spread signals, walking you through the thought process for the technical signals that we derived, and then how do we deliver that into credit spreads to you. And then at the very end, what we'll do is we'll try to go through as many examples as possible of current stocks that we're looking at some credit spreads on those stocks, and showing you how to actually go through this process using options play on your own for those of you that are looking to sell credit spreads on your own. Now, before I actually get started with talking about what are credit spreads, I just want to do a quick poll here. How many of you have traded credit spreads before? I just want to get a sense for the audience here in the room. I want to get a sense for how many of you have traded credit spreads, how many of you are learning, and how many of you are not even sure what a credit spread is. Okay, so we've got about 2/3 of you that have voted already. So it looks like about 2/3 of you have traded credit spreads, about 1/3 of you are still learning, and 8% of you say you're not sure what a credit spread is. Okay, so for those of you that have traded credit spreads, this is really designed to help you better understand the strategy and not just sell credit spreads because you believe that you want to generate a credit. We want to make sure everyone understands when should they sell credit spreads and what are the ideal credit spreads to sell. For those of you that are still learning, that's really what we're here for, is to really break down the strategy and make sure you understand everything from the very nuts and bolts to it. And then for those of you that are not sure what credit spreads are, hopefully this webinar answers that question for you. So that's the results here, just real quick to show everyone. Let's go ahead and get started here. So let's talk about what are credit spreads. So first of all, these are what we consider limited risk and reward strategies, just like debit spreads, and they typically have high probability of profits. Now, this is one of the reasons why I think it's a popular strategy, because everyone wants to hear high probability of profit. But in reality, high probability of profit has its trade-offs. So what we want to do is we want to explore what those trade-offs are and make sure you understand that you're trading the right credit spreads and not just optimizing for really high probability of profit, because if you do that, chances are you're going to lose money in the long run. Now, it's really important to understand that before we even break down a credit spread, is that these trades are effectively short theta and short vega, meaning you're short time decay and you're short volatility. So those are the two distinct differences between trading credit spreads and most other strategies, is that you are short volatility and you are short time decay. So you want those two things to work in your favor, in addition to all the other things that can potentially move in your favor, such as the underlying stock. So there are effectively two different credit spreads that you can trade. One is when you have a bullish or neutral view on an underlying stock or ETF. This is what we call a bull put spread or a short put spread. And then if you have a bearish or neutral view on a stock, you can sell a bear call spread or a short call spread. So what I want to do in the next couple of slides is actually break down these two strategies to make sure you truly understand each one of these two strategies. So first, we're going to cover the bullish example. Here, I'm going to use fictitious stock XYZ that's trading at $100. And what I want to do is I want to break down this trade to show you the rationale behind why someone sells a credit spread. And it's really just a one-leg trade in reality. Even though it's a two-leg trade, the short leg is really the leg that matters. Okay, so we have stock XYZ. We're slightly bullish on it, and what we want to do is we want to show you how you can sell a credit spread to take advantage of a bullish or neutral view on stock XYZ that's currently trading at $100. So the credit spread starts off with, or the most important leg of a credit spread, is selling a put to begin with. So because when you sell a put, that's naturally a neutral to slightly bullish strategy. That is where we get this bullish neutral view on, is by selling a put. Now, the reason that we sell a credit spread instead of just outright selling a put is because selling a put is quite risky, because you are risking the stock going all the way down to zero, and you have unlimited risk as long as the stock continues to decline. So this is really one of the reasons why instead of selling just outright puts, you want to sell a credit spread by buying a lower put against that. So here what I'm selling is an at-the-money put. Let's say I'm collecting $4 for that at-the-money put. And then what I'm going to do is I'm going to buy back a lower put, a $90 put for $1. And the reason I do this is because I want to have limited risk. I don't want to just sell a put and then have unlimited risk all the way to the downside. I want to cap that risk. And I can do that by buying that lower put. So this lower put in this particular case cost me only $1. So my net credit here is $3 because I'm collecting $4 by selling that $100 put. That's the bullish to neutral view that I'm expressing in stock XYZ by selling that $100 put. But because when I sell that put, I don't want to have unlimited risk, I'm going to buy that $90 put for $1 and cap my risk at, so my net credit is $3, and that means my max reward on that trade is $3. Just like when you sell a put, the credit that you receive is your max reward. When you're selling a credit spread, your max reward is also the income that you receive. So the $3 credit, and your max risk is the difference between these two strikes, the $100 strike minus the $90 strike, which is $10, minus the $3 credit that you receive. So the max risk is $7. So the opportunity you have with any credit spread or any debit spread for that matter is always the distance between the two strikes. Whatever your max reward is, the rest of it is going to your max risk and vice versa. So when you're selling credit spreads or trading any type of spreads, your opportunity is defined by the difference between the two strikes. And what you're effectively doing is you're choosing different strikes to make sure that you have the risk to reward metric that you're seeking. Okay, and that's what we're going to talk about here today is what is the right strikes to pick on a credit spread. And this strategy is what we call a very forgiving strategy because even though I'm bullish on stock XYZ, this strategy is profitable as long as stock XYZ closes above $97 or higher. So even if the stock goes down $2, I'm still profitable on this trade. Now, that can't be said for most other strategies because if you buy a call option, that stock not only has to move in your direction, it has to move in your direction by a considerable amount before you're profitable. Here, when you sell a credit spread, even if it doesn't move in your favor, even if it moves against you, you can still be profitable. So it's a very forgiving strategy. And this is part of why I think it is a very popular strategy amongst traders. Now, like I said, that trade-off, there are some trade-offs with that, so I want to discuss some of those things here today. So this is an example of what we consider a bullish credit spread, is selling a put vertical to take advantage as long as stock XYZ stays where it is, moves higher, or even moves a little bit lower, we can profit from this particular trade. Next, what I want to explore is a bearish credit spread. So same stock XYZ, but in this particular case, I have a bearish or neutral view on stock XYZ. So traditionally, if I was just trading single leg options, I can sell a naked call. I can sell a $100 strike call. Let's say I collect $4. That is in itself a neutral to slightly bearish strategy. However, when you sell a naked call, that has unlimited risk, meaning if the stock goes against me and starts rising or starts rallying, I have dollar for dollar unlimited risk to the upside. So in order to cap my risk, instead of just selling a 100 strike call, I'm going to buy a 110 call against it. Same thing here. That's going to cost me $1 to buy that 110 call. So again, my net credit is $3, which means on this particular credit spread, I have a max reward of $3 because that's the credit I received. And again, the max risk is $7, which is the difference between the strikes minus the net credit that I received. And this bearish strategy, this bearish credit spread that I've sold is profitable as long as stock XYZ closes below 103 at expiration. So just a strike price plus the $3 premium that I receive. So even if I'm wrong on my analysis and the stock rallies a couple of bucks, I can actually still make a profit on this particular trade. And if the stock moves lower, I keep my $3. And only if the stock rallies significantly do I start risking more money. And my max risk is $7. So if it goes to even $200, I'm still only risking $7 on this particular trade. So as you can see, this strategy gives me what you would consider a pretty high probability of profit because if the stock stays where it is, moves a little higher, moves a little lower, I can still make profit. That can't be said for many other strategies. So with that, what I want to talk a little bit about is now that we understand the strategy, I want to talk about when should you actually utilize this. So we've already said that this is a strategy that is a very forgiving strategy. It's a forgiving directional strategy for either a neutral or mild move. So what that means is that you should trade credit spreads when you're expecting a neutral to small directional move. So when you expect the stock not to move a lot, when you have a good sense for direction, but you don't think it's going to move very much, or you think it's just going to stay in a tight range, that's really when you want to sell credit spreads. These are generally good for when you've identified extreme overbought or oversold conditions. So there's many technical indicators that do this, but many of you that use momentum indicators like MACD, RSI, stochastics, these are all momentum indicators that are designed to identify overbought and oversold conditions. Credit spreads are an ideal strategy for when you've identified these overbought and oversold conditions. They're also useful for reversals. So for those of you that don't use any technical indicators, but use price action, so whether you use top and bottom formations like double tops, double bottoms, head and shoulder reversals, or even just plain vanilla support and resistance levels, you can use them when you have identified a floor or a ceiling, which is just another way of identifying overbought or oversold conditions. And lastly, this is a strategy that you do not want to use when you're expecting a large and fast move in an underlying stock. So if you're expecting a breakout or a breakdown, or if you think the stock's going to gap higher or lower going into earnings, this is not the strategy that you want to use in those conditions. So again, this is when you expect volatility not to go a lot, you expect maybe even volatility to contract, that's when you want to sell credit spreads. So again, that's why we don't want to compare credit spreads to debit spreads, because they're used for completely different scenarios, basically the exact opposite scenario. Debit spreads are for when you expect a large move. Credit spreads are when you expect the opposite. So now that we've talked a little bit about the strategy itself, when should you use it, I do want to bring up some of the things that we've learned from all of the back testing that we've done on this specific trade. And this also comes out of some of the feedback that we've gotten from users asking us why we don't sell a lot of credits, call credit spreads when the markets are reversing or the markets are heading lower. And the reason for this is because we've tried all different types of bullish and bearish strategies in the market. And what we found is that puts have an edge over call credit spreads. So meaning bullish put credit spreads have an edge over bearish call credit spreads. And the reason for this is because when you're in oversold conditions, when it's time to sell that put vertical, when the market is oversold, what you tend to have is elevated implied volatility. So number one, credit spreads, because you're short volatility, do have an advantage when volatility is high, and volatility is high near market bottoms. And what happens is that when the market rallies, that volatility contracts. So because a credit spread strategy is effectively short volatility, this is the ideal condition to sell a put credit spread, because you're able to do so when volatility is high, and when the market rallies, volatility contracts, and you're able to take advantage of that contraction as well. So this is why selling put credit spreads gives you an edge over selling call credit spreads. That's not to say that when you sell call credit spreads you can't make money. It's just that the edge is tilted in your favor when you're selling put credit spreads. On the other hand, when you're selling call credit spreads, when the markets are overbought, meaning when they're near its tops, that's when volatility is typically lowest. So you have muted implied volatility to begin with, which means that you're selling volatility when it's very low. And when you're expecting the markets to decline, that's when the markets decline, market volatility expands during that time. So because you're short volatility, and if volatility actually expands during the time that you're in that trade, that piece of the pie is working against you, which is why, again, based on our research, even though both strategies are completely valid strategies, you'll tend to find that it's better to trade more puts than calls. So here's an illustration of what the type of conditions that you typically look for when you're trying to sell a credit spread. So here I have a chart. This was a chart of, I forget what stock this was, but this was a stock that traded within a pretty big range over here and started trading in a tighter and tighter range into this triangle and made a big breakout. And on that breakout, that's when we expect a big, fast move. And those are ideal conditions for buying a debit spread, when you're expecting a quick, big move in an underlying stock. Versus when that stock later, a few months later, started trading in a very tight range between 101 and 103, these are your ideal conditions to sell credit spreads. So for those of you that follow momentum indicators like stochastics, as you can see, in these range-bound markets, it goes from overbought to oversold to overbought to oversold very, very quickly. And every time it's oversold, you can sell these put credit spreads. And every time it's overbought, you can sell these call credit spreads. And you can basically string these along. You can even sell a call credit spread here, and about 5 days later, sell another put credit spread, and a couple of weeks later, sell another call credit spread, and a few weeks later, sell another put credit spread. You can do this over and over again on the same stock when you're selling credit spreads, versus on debit spreads, likely you're only going to identify a big move once in a while. You're not going to be able to do that all the time on an underlying stock. So that's really where, there's a fundamental difference between trading credit spreads versus debit spreads. And I hope that this helps illustrate that purpose, so that you're never in your head thinking, well, should I trade a credit spread or a debit spread today? In reality, it shouldn't be that difficult of a decision, because they are used for completely different market scenarios. So to better understand credit spreads, the reason I want to bring this up is because I hear from a lot of users, people selling credit spreads that have very, very high probability of profits. And naturally, I understand why you want to sell a credit spread with very high probability of profits. However, it's really important that with any type of trading, that you really understand the relationship between probability and risk to reward, because they're at opposite ends of the extreme. And it's like a seesaw, because if you have really high probability, what you're going to get on the other end is really poor risk to reward. And what you want to do is figure out what is the right balance between the two. So the extremes that you typically find when you're selling credit spreads is when you're selling credit spreads that are near the current price. So strike prices that are near the current price of the stock, you're going to see much lower probability of profits. Usually 67% is usually 60 to 70%, I would say, is average for when you're selling a near the money credit spread. But with that, what you're going to get is a pretty good risk to reward. You're typically risking about $200 to make roughly about $100 in income. Vice versa, if you sell really far out of the money credit spreads, what you're going to get is really high probability of profits. 90% winners, 95, even 99% I see gets traded a lot. And these have what I would consider very, very poor risk to reward ratios, where for every $100 in income that you collect, you're risking $900, $1,000, $1,500. I've seen even $5,000 people risk for just $100 in income. And the reason that we always suggest that you keep to this end of the spectrum, selling credit spreads near the money, is because in far out of the money credit spreads, even when you have 95, 99% winners, what you're going to find is that one loser that you have will likely wipe out all of the trades that you've made, if not more, prior to that. And that's just not a good strategy in the long run. Yes, you can collect pennies in front of it's what we call collecting pennies in front of a freight train. So yes, you're going to be able to do it a lot, collecting money all the time, but that one time that the market reverses significantly, like in December, and even December 2018, a lot of users got caught out by this specific strategy, including us. But because we had strategies that have not bad risk to reward ratios, we weren't losing $1,000 for that $100 income. We were only losing $200 on those specific trades. So that allowed us to survive those types of declines in December 2018, which is something that I'll talk about a little in terms of what we learned from that sell-off as well. So now that we've identified what credit spreads are, when you should consider trading them, what type of strikes you'd be looking for, we wanted to share with you, based on all of our back testing, what type of credit spreads we found were optimal. And it's very clear from all the back testing that we've tried all different types of expirations, all different put and call combinations from different deltas, to identify what are ideal scenarios to sell credit spreads. And it's very clear that you want to sell relatively short short dated options. 4 to 6 week out is usually where we find the sweet spot with selling credit spreads. On the credit spreads that we sell in our trading room, we exclusively sell 4 to 5 week credit spreads, and we always sell the 50 delta call or put, so the at the money call or put that we sell, and then we always buy back that 25 delta call or put to cap our risk. And when we follow this type of strategy, what we see is that the credit that we receive is roughly going to be a third of the distance between the two strikes. So this is really one of the ways that you can use, this is kind of like the golden ratio that we use. So if you're just looking at an option chain and you're trying to eyeball what is the right strikes to sell on a credit spread, you always want to start at the selling an at the money call or a put, and then try to buy back a put that will always give you roughly a third of the credit of the width. So if you're selling a credit spread that's $1 wide, meaning the distance between those two strikes are $1 wide, then you want to collect roughly about 33 cents. And $3, you want to collect about $1, and so on and so on. So this is a chart just to give you a very quick reminder of, if you're selling a $10 wide strike, you want to collect roughly about $3.33. If you're too far below that or too far above that, that means your strikes are a bit out of whack compared to this type of scenario. So these are the types of risk to rewards that we typically see with this type of strategy. So like I said, roughly about 67% probability of profit, which is certainly on the lower end for a credit spread, but it has significantly better risk to reward. You're only risking roughly $200 for every $100 in income. We tend to find that when we go too far beyond that, so around a 1 to 3 risk to reward ratio, that's when these strategies start to underperform, because when you're risking more than 3 times when you're collecting an income, all it takes is just a couple of bad weeks for you to wipe out, a few months worth of profits. And we really want to avoid having those types of scenarios. So with that, what I want to talk about is how to manage these spreads. So now that we've talked about what credit spreads are, when you should use it, what are the optimal ones, how do you actually manage these trades? So number one, with the entry, I think we've covered that fairly comprehensively. You want to time these entry trades when you expect a market top or bottom. And when I say market top, I mean stocks or ETFs, the individual stock or ETF that you're trading. So whenever you identify a top or a bottom, and whether that's using technical indicators or using price action data, whenever you identify these tops or bottoms, that's when you want to enter a credit spread. Now, once you're in that credit spread, the goal of a credit spread is simply let the spread expire worthless. So if you collect $1 in income, you want that spread to expire worthless so that you keep that $1 credit. Now, we tend to find with credit spreads, you do have to manage them fairly actively, unlike some other strategies. So there's generally 2 things that you need to consider. Number one, if you've made gains of more than 50% and there's more than half the amount of time left to expiration, that is when you want to take profit early. So this is really what we say, when you're ahead of the game, that's when you want to take profit. So if you've made more than 50% of the potential income you can receive on a credit spread, when you still have more than half the time left to expiration. So if you sell a 4-week credit spread for $1 and you make 50 cents in the first week, you're ahead of the game. You should take profits early based on our research. Now, on the flip side, if it starts to go against you, this is really where it depends on how much credit you receive. So this is really where, this is why in my opinion, credit spreads are a little bit more advanced, because there's a lot more things that you need to consider to decide when in terms of how to manage this trade. So if the credit that you receive, the income that you receive on the credit spread is greater than 1/5 of the vertical width. So in our example, we are saying that the optimal one is 1/3. So that's exactly what this case is. You want to cut your losses when you've lost anywhere from 75 to 100% of the credit that you received. But for those of you that sell really high probability out of the money credit spreads where the credit you receive is less than 1/5 of the vertical width. So if you sell a $10 wide vertical spread and you're collecting less than $2 or so and you're risking $8 on that trade, that's when you want to cut your losses, where you've lost anywhere from 100 to 200% of the credit that you received. So This is a basic rule of thumb that we've discovered based on our backtesting of these types of strategies, and these are the types of rules that we utilize in our credit spread trading room that I want to show you guys. So before I jump over to options play and show you some real samples, what I want to again show you is that options play currently offers a credit spread trading signals, and this is based on the quantitative work that we've done over the last 6 months to start the credit spread trading strategies and the optimization that we've done over the last 6 months to improve our signals to really help us alleviate kind of some of the losses that we had in December. So what we're currently offering as an exclusive on this webinar is a free 7-day trial to our credit spread signal service. So for those of you that want to try it out, you can try it out for 7 days. And afterwards, we're offering everyone a 20% discount off of the $39 a month rate. And what you get for this is daily credit spread signals. You get entry and exit signals in real time delivered to you either through email or phone notification, and you get roughly about 3 to 4 signals a week on average with this type of strategy. And this discount code is good for the next month, so this discount code expires on May 20th. So you can take some time, for those of you that are still learning about the strategy, to learn more before you sign up for that free trial and subscribe to this and get the discounted code for this. And I sent the link to everyone here in the chat window, including the discount code for those of you that want to check it out. And what I want to just talk you through is how we actually derive these credit spread signals. So we get a lot of questions about this, so I wanted to put some slides together to give you a sense for the quantitative work that went into creating these algorithmic signals. So here's an example of a chart, Anthem. What we're looking for is quantitative algorithmic signals on the underlying stock itself first. So what we want to identify is extremely oversold conditions in a stock, and we have a proprietary algorithm to determine when we consider a stock is extremely oversold. And as you can see, these arrows identify these extremely oversold conditions on this particular stock. And when these signals are generated, what we see is a very high amount of accuracy, anywhere from 60 to 65% chance that the stock will reverse higher over the next 4 weeks. And we typically see on average about 2 to 3% returns on just the underlying stock over those 4 weeks, is the type of algorithmic signals that we've identified using our resources here to backtest thousands and thousands of technical indicators to give us a sense for what gives us the highest probability trades. Because when you're selling credit spreads, you want high probability signals. So what you really want is, and the stock doesn't have to move very much in your favor, because even if it stays flat, you can still make money on a credit spread. That's the benefit of it. But you do need to have very high accuracy rates. So those are some of the things that we optimize for in our models. And then off of the back of that, what we do is we sell credit spreads when we generate these signals. So we provide optimized expiration and strike prices based on the methodology that I just showed you here today. We provide real-time entry and exit alerts. We provide you with P&L analytics for those of you that have a subscription to Options Play. We send you a link to the trade in Options Play so that you can test out your outlooks on the strategy and maybe even make modifications to the strategy before you place that trade. And lastly, we offer weekly performance reporting on all of our trade signals here using Options Play. And just to give you a sense for what you're going to get in this particular room, here's a sample of an actual trade entry that we sent out yesterday and a trade exit that we sent out earlier today. They're very straightforward and easy to read. They're meant to be really short and concise so that you can take a trade, in your email or on your phone and immediately enter it for trading as quickly as possible. We give you supporting evidence of the underlying chart as well as an image of the trade, and we tell you exactly what the trade is. We tell you whether it's an opening trade, and we'll tell you how much credit that you received, as well as the details for which leg to buy, which leg to sell, what are the premiums of each leg, max reward, max risk, and a link to the specific trade with the images. And then on a closing trade, we'll tell you a little bit about why we're closing the trade. We'll tell you that in this particular case, this is a take profit, what price to take profit at, how much gains there were on that particular trade. And then again, giving you a link to those trades if you want to track it within Options Play. So this is just a very quick sample of what you'll actually receive from subscribing to the Options Play signals for those of you that are interested in getting an automated trade alerts on trading credit spreads. So with that, what I want to do is I want to jump over to Options Play, and I want to show you some real samples of selling credit spreads, and then showing you also a little bit about the signals that we send out in our Options Play room. So first, I want to just open this up for anyone who wants to provide some symbols to take a look at. So if you have a specific symbol you want to look at, please type them into the chat window. I'll try to spend a little bit of time on this particular trade. And what we're trying to do is we're trying to identify stocks that are oversold for various reasons. And for example, I think healthcare was one of the sectors that we really took advantage of this week, because last week we had that huge sell-off in healthcare because of that Medicare for All news. A lot of hospital stocks got sold off, like HCA, Bristol Myers. These were the stocks that we want to take advantage of, because we didn't feel that there was a fundamental shift in any of these specific companies, yet the price action was extremely weak on these. So we thought there was going to be a bounce higher. And that's exactly what we saw on stocks like HCA, where we had that extreme move to the downside and then a whip saw right back up. And these are ideal conditions to sell credit spreads, because when you get this huge sell-off, implied volatility is really high. And that's what you want when you're selling your credit spreads. You want implied volatility to be really high, and then as the stock rallies back up, implied volatility will contract. And that allows you to not only have directional exposure in your favor, so delta in your favor, but also vega and time decay. And this is really why, again, why selling put credit spreads again gives you that higher edge, because you have delta working in your favor, you have vega working in your favor, and you have theta working in your favor. All three things that usually there's at least one of them working against you in most trading strategies, but with the exception of selling put credit spreads, all three are working in your favors. And those are the types of ideal conditions we're looking for when we're selling credit spreads. So I'm going to start off by looking at Bristol Myers. Because this stock really bottomed yesterday around 44. As you can see, it rallied up to 45, about 2.5% today. So let's say I'm bullish. I want to take a contrarian view on BMY. Here I'm going to modify this stock leg. I'm going to sell a put credit spread rather. Like I said, we usually want to sell about 4 to 5 weeks out. So May 24th is usually a good starting point. And then what you want to do is you want to try out different strike prices that give you roughly that 2-to-1 risk reward ratio. So here I have a strike price that are $2 wide, 44 to 46. I'm collecting $77 or so, just a little bit above that 1/3 that I'm looking for. So this would certainly be the type of credit spread that I'm looking for on Bristol Myers. And as you can see, if the stock stays around 45, 46, that's when I'm able to collect my $77 profit. So even if the stock just stays exactly where it is and it doesn't move much higher or much lower, I'm going to collect my $77. And my break-even price on this stock is only $45.23, which means that even if the stock stays exactly where it is at $45.50, or even moves a little bit lower, I still at least make some profit on this particular trade. Now, the only downside to this particular trade is that even if the stock does rally, if it does rally back up to $48, $49, $50, which I think that this could potentially make it there, I'm still only going to make my $77 profit, which, like I said, if I'm expecting a big move, this strategy is not the most optimal strategy to do so. And vice versa, if the stock really drops, the most I'm risking is $123, roughly about 1.5 times what I'm collecting on the income. Those are the types of ratios that I'm typically looking for. So that's just an example of a credit spread that we traded in our room, and hopefully you guys are able to follow as well. So let's take a look at some of the names that you guys are looking for. I forgot to say that if you're going to submit a symbol, please type also whether you're bullish and bearish on it. Sorry, I forgot to mention that. But let's look at Freeport McMoRan. From my eye, this is certainly a bullish trade. I find that there's probably a little bit of support around 13.50, 13 bucks, 13.50 or so. So in this particular case, do I think the stock's going to make a rally back up about 14.5? I would say that that's probably a realistic target price. So let's again do a short put vertical. Let's look at May 24th, which is roughly 4 weeks out. Here, maybe I'm looking at maybe $1 wide. So maybe I'm selling a $12 put, buying back $11 put. That collects me around $30, which is, again, roughly a third of the width between that $11 to $12 put. So this is exactly the type of spreads that I would be looking at. And as long as the stock stays around $13.50, I'm going to be able to collect my $30 profit. And even if the stock moves down to $12, right? So look, even if the stock rallies, declines back to $12, I'm still going to make my $30 profit. So this is really how versatile this strategy is. Now, even though I don't necessarily think that Freeport FTX is oversold, I wouldn't necessarily call these oversold conditions, but you certainly have this small price pullback, and those are the types of things that you're looking for when you're selling a credit spread. AMD. So AMD, certainly is near the support level. So in my opinion, this is not an ideal time to sell AMD because AMD is near its all-time highs, unless you're bearish on AMD. That would be different, right? So maybe you think that AMD is going to top out here around 29 bucks and it's not going to go any higher. Then you might be bearish and then sell a call credit spread. So here in this particular case, let's say I'm selling a call credit spread. And let's look at maybe a $2 wide spread to start out with. So I'm selling the 28, buying the 30. Maybe I got to go a little wider, maybe the 31. So a $3 wide spread, 28 to 31 is $3. Here I'm collecting 102, which is roughly a third of that width. So as long as AMD stays below that $29 level, I'm able to make money on this particular trade, which gives me still a little bit of room to the upside. Before this stock gets called, before this strategy is taking a loss. So this is really the type of strategy that I would be looking for when I'm selling a call credit spread. If I feel that this is a double top and it's going to top out here, it's not going to go much higher. Now, this is a technology stock that reports earning in 5 days, so I probably wouldn't be making that bet. If anything, I'd be making a bet that this stock is going to rally higher. But if I was going to do that, I'd probably be better off buying that debit spread because that's really going to allow me to take an upside risk to reward with substantially more reward than risk that I have. So in this particular case, if I was trading AMD, I wouldn't probably trade a credit spread on this. IIPR, I'm not sure what stock this is. I'm not even sure that there are weekly options on this particular trade. So I will say that, on stocks that there are no weekly options on, chances are you're not going to find the right strikes to sell on a credit spread. But let's take a quick look here. So this stock certainly took a huge dip over the last few weeks or so. Maybe you're bullish on this and you think it's going to rally back up or at least hold this $45. This is a $86 stock. So I have to take a look at this data. So this is an $86 stock. We'll come back to this stock in a little bit. Let's look at Microsoft real quick. This stock just reported earnings yesterday. So I don't know what your views are here on Microsoft, but these are not ideal conditions for selling any credit spreads because it's near top, unless you feel that this stock is at its peak and it's going to reverse lower, or you think that it can't go much higher above 126. If that's the case, then you might want to sell a call credit spread, such as this, where you might want to sell a May 24th, maybe sell the 129s, buy back the 134s, which is roughly about a $5 spread, and you're collecting $183, which is again roughly one-third of the width of that $5 wide spread. You're risking 317 to make 183, and as long as the stock stays below 120 or 130 or so, you're going to be able to collect 129. You're going to be able to collect your $183 credit as long as it stays where it is, moves a little lower, or even moves a little bit higher. So even if the stock rallies up to about 130, you're still going to be able to make some profit. So this is really just to give you a sense for what it feels like to sell a credit spread. Now, I didn't quite have enough time to get to more examples here today, but I do want to give you guys, for those of you that are interested in the call credit spread, the credit spread trading signals, just to give you a sense for how we post things. So what you basically get is a stream of of entry signals. So here's a Wells Fargo trade that we sold yesterday, and take profit alerts. And you basically just get them in real time. You get them by email, or you get a phone notification that tells you exactly what the trade is, which legs to buy, which legs to sell, max reward, max risk, and a link to the trade, and then showing you a chart of that stock or ETF, as well as a snapshot of the trade itself, so that you always have a record of every single trade. Here's a Hess trade the other day that we took profit on. So energy stocks were oversold a couple of weeks ago, and we got into a lot of those stocks and we're able to take profit on that. And this week, or last week, we really sold a lot of healthcare stocks as the markets really sold off, like Pfizer. And then you can click on any of them if you want to see each individual trade, and you can actually track these trades. So as you can see, Pfizer, when we sold it, Pfizer was trading around 39.32. As you can see, it's rallied up to 39.60. So here we've made $10 on this $65 credit spread. So at the time we collected $65, now that spread's trading at $55, so we got a $10 profit on that particular trade right now. That trade is still open, but as you can see, what you get is a stream of trades and the take profits. This was the HCA trade that we opened up a couple of last week, American Express, where we took profit, and you just get all of these streams in real time. You can log into the platform to see them, or you can just wait for the emails to get into your inbox every day for those trades. So that's just a very quick overview, and here's a quick sense for the returns that we're seeing, and we provide a sample of every single trade that we've ever traded, the entry price, the exit price, the return on capital. You can see all of our open prices, and you can see the performance. This is what you're going to get when you subscribe to our credit spread trading strategy in a report, in addition to what you get here already with options play. So with that, what I want to do is I want to thank everyone for taking the time out here this afternoon. I want to open this up for Q&A. I'm sure there's going to be a lot of questions, as I see that there's already a lot of questions in the chat window. So I do want to take as much time as possible to answer the questions that you guys may have regarding credit spreads or our trading signals that we provide. So let's see. Bob's asking, can you please kindly clarify, does your platform available on Merrill Edge? There are different versions, Bob, that are available through Merrill Edge versus through First Trade. So yes, it's available through both platforms, but they are slightly different versions. So if you want to find out more, you can send me an email at info@optionsplay.com, and I can answer those questions for you. Where will I find the recordings later? So we will email everyone the recordings, but you can also always go to our YouTube channel, which we have all of our Learn to Trade Options webinar series. So we always post the latest videos to this playlist. So you please subscribe to our YouTube channel if you want automated updates. But we always email you everyone right after the webinar with the recordings. StockTwits is showing an error in applying the discount code. So is anyone else having that same problem on StockTwits? Christopher is asking, do you have a subscriber to options? Do you have to be a subscriber to Options Play to subscribe to the Signal service? No, so you do not have to be a subscriber to Options Play to subscribe to our trading service. Those are a completely separate standalone service. Okay, so it looks like the promo code or discount code is working for everyone. Great. Christopher, I hope I answered your question regarding whether you have to be a subscriber or not. Do you send the signal or you have a trading room? So we have both. We have the signal and you have the room as well. So you can either come to the room to get the signals, or you can just wait for the emails or notification. Amir is asking, what's the difference between a short time frame credit spread and a longer time frame credit spread? Between 1 week and 5 weeks. So the only difference between a 1 week credit spread and a 5 week credit spread is that when you sell a 1 week credit spread, there's not going to be much income at all. And you're going to take, so let's say we look at a 1 week credit spread here. So here, let's say I sell that $29 credit spread, and then I buy back a 130 call credit spread. So There isn't a huge difference. However, what I would say the biggest difference is that when you sell a 1 week credit spread, it's extremely sensitive to moves in the underlying price. If this price moves against you even a little bit, you're going to see yourself with a large loss very, very quickly. But that also means that if it moves in your favor, you're going to see a large gain very, very quickly. So a 1 week credit spread is extremely time sensitive because you have a lot of gamma risk on a 1 week credit spread versus a 4 week credit spread. So generally speaking, gamma risk is not what you want when you're short volatility. So this is really one of the reasons why we always go 4 to 5 weeks out when we're selling these credit spreads. Shalom is asking, I just signed up for your service. Which room should I go to in StockTwits? So it's specifically this one. You have to go to this link to enter our credit StockTwits room. I just put it into the chat window for those of you that are interested. So Michael is saying, near the money example, the math seems to indicate a zero-sum game. So it's a zero-sum game if your technical signals give you a 50% accuracy rate. You're absolutely right. So if, let's say, you have these technical signals like the ones that we have that has an accuracy rate of 50%, then yes, you're going to have roughly a zero-sum game. And this is really where your edge is. Your edge is in how good your technical signals are, which is why we've spent a considerable number of resources to optimize for high probability algorithmic technical signals. So Michael, I hope that answers your question. James is asking, what delta do you usually sell for your credit spreads? 30 delta is what I hear most often, but I also hear 16 delta, which is 1 standard deviation away. So I think I made it pretty clear in from our perspective that when you're selling credit spreads, it is we've tried out all the different combinations, and selling the at the money 50 delta and buying back a 25 delta call or put is what we have found to be most profitable on our strategy. You send these signal points to us when they occur? Yes. So you get an email notification or a phone notification when the signals are generated in real time. So Wayne, what about earnings coming out on BMY? So this is one of the reasons why we've already closed out that BMY position. I was just saying that as an example of a trade that we made last week. So I know some of you answered like you're bullish on AMD or you're bullish on Microsoft. Like I said, these are not ideal conditions to sell a credit spread. Like I said, credit spreads are for when you see and identify an overbought or an oversold. If you think that a stock is bullish and it's already bullish, it's time to just buy, calls or debit spreads. That is a far better deployment of your capital. So here, let's go back to Microsoft here. And let's look at a debit spread here, 129, 136. We buy a debit spread versus selling a credit spread. I hope that this will help illustrate why you want to do a, whoops. So let's normalize this. Let's say I'm willing to risk $2,500 on this particular trade. So here I'm selling 7 contracts with a credit spread. I can buy 8 contracts with a debit spread. If you're bullish on Microsoft, as you can see, even a modest move to the upside, let's say the stock moves up to 135, which I don't think is that crazy on this particular stock, considering the amount of moves that we've seen already. It's trading at 129 right now. So a $5 move in the next 36 days or a month or so, as you can see, for the same $2,300 that I'm risking on the credit spread versus the debit spread, if this stock just moves $5 higher, I'm going to make roughly 2.5 times more money on the debit spread than I am on the credit spread. And I really hope that this illustrates to everyone why you don't want to sell credit spreads just because you're bullish or just because credit spreads have a high probability of profit. Because I see a lot of users that will tell me, hey, this credit spread that I sell has a 60% probability of profit versus this debit spread only has a 35% probability of profit. So it obviously makes sense that I'm going to sell the one with the higher probability of profit. But as you can see, yes, you have a higher probability of profit, but you have a higher probability of profit of making less money. It doesn't account for the fact that you might have a lower probability of profit here, but you have a lower probability of profit of making more money. That's why the probability of profit here is so much lower. because you can make substantially more money. So if I do believe the stock's going to rally just $5 higher, I would certainly want to trade the debit spread versus the credit spread. So these are not what I would consider ideal conditions to sell a credit spread. And I hope that this really kind of shows you why and how to make that judgment yourself. I'll come back to try to do one more example of some stocks that someone's that wanted to look at. So Raymond wanted to look at Boeing, and he's bullish on Boeing. So Boeing is an interesting example because this thing's really taken a huge tumble. This was actually one of the trades that we traded near this very bottom, is because we felt that this tumble was a little overdone and we were expecting the stock to kind of bounce higher. So we actually traded this Boeing trade. Let's see which day it was. So we traded this on March 27th. We sold the 372.5 by 352.5 put credit spread for 655. So this was a trade that we made after it made that huge tumble on March, what did I say? March 27th. On March 27th. So this was around right here. Right after it bounced off the bottom multiple times, we found that this was kind of hitting that support level, and we felt that this was going to make a move higher, and that's exactly what happened. And just a few days later, we were able to take profit. We sold the credit spread at $6.55 on March 27th, and then on April 1st, just 4 days later, when the stock had rallied, we bought back that credit spread for $1.87. That made a 35% gain. So here's an example of trading Boeing when it was near that bottom. Now, are we in that similar situation again in Boeing? Possibly. I don't think now is what I would consider extreme oversold, but I certainly still think that this is potentially oversold. So if you do think that this stock's going to make a small bounce, maybe up to 395 or so, or 380, 390, I do think that selling a call credit spread or a put credit spread may be suitable for this. So maybe here what I would do is I would sell maybe a 382.5, sell a 382.5 and buy back maybe a 357.5. Or no, that's probably too wide. A $15 wide credit spread, collecting roughly a third of that, 570. As long as this Boeing stock stays around 380 or so, I'm able to collect, 390 or so, I'm able to collect my $570 profit while risking $930. So this is what I would consider a fairly decent entry point for going long a credit, or going short a credit spread on Boeing. So there's a lot more. Symbols that people have asked me to look at. I'll try to come back to this after answering some more questions here. So Paul's asking, selling 50 delta puts, do you use stops? Did research show that you got stopped out some of the time? So yes, so we've generally found that for the most part, we don't want to use stops unless we get an extreme move against us. The reason that we sell these limited risk strategies is because we don't need, the reason that we trade limited risk strategies because we don't want to just get stopped out, right? You typically use stops on strategies that have unlimited risk. So when you're long a stock or short a stock, or if you're long futures or short futures, you have unlimited risk. And that's really when you want to use stops to mitigate your risk. But when you're trading options, for the most part, or all the strategies that we typically cover here, they all have limited risk, which means that we don't need to have stops because we already have a stop because it's a limited risk strategy. So that's why, for the most part, we don't use stops on our trades. Stock twits versus options play. Not sure what the question there is, Larry. They're both platforms. We leverage the stock twits platform to send out our trading signals and to host all of these rooms, if you will. So it's a separate service, but we leverage their technology to help us deliver these signals. JB, can you show the winning rate and capital return slide? Yeah, so it's right here. For those of you that want to look, I'll also include a link in the chat window. Can we close the transaction at any time? Yes, you can close any credit spread prior to expiration at any time. Do you find that you use the same stocks over and over again? Chaikin shows Microsoft very overbought. So we tend to find that when things get oversold, they tend to be very similar. So for example, all the healthcare stocks got extremely oversold last week, and that's when we got into long healthcare. The week before that, it was energy. So we went long a couple of energy stocks. So we tend to find that there's a lot of overlap across the sectors when we see these large moves. So we may not necessarily trade the same stocks over and over again, but Boeing is one of the stocks that has come up over and over again for the last few weeks. You know, we identified a Boeing opportunity on the initial sell-off and then a subsequent sell-off. So yes, we do find that we trade the same stocks over and over again. Is everyone still having issues with the promo code? And just out of curiosity, 1 second here. It's possible that the O in ops is capital. Let me just check. Nope, it's all lowercase. So is everyone still having issues with getting that promo code in? Looks like it's working for some users. If you're having issues with the promo code, please send me an email at info@optionsplay.com, which I just sent in the chat window, if you are having issues with that. Could you put on, James is asking, could you put on a debit spread on BA as an example? Absolutely. So here in the example here, I have the debit spread here on BA as well as the credit spread. And let me just first normalize this and say I want to risk, let's say, $3,000 on this trade. So here I can sell 3 contracts of the credit spread, 2 contracts of the debit spread. So as you can see here, if I expect the stock to just move modestly higher to 390, the credit spread clearly is the winner here, and the debit spread is actually losing money. So if you're not expecting a big move or a neutral move, that's again when the credit spread is going to take advantage of that. But when you do expect a big move, so even if the move up to, let's say, 400, as you can see here, I'm making $1,700 credit on the credit spread, $1,100 profit on the debit spread. So if the stock rallies up to 400, still the credit spread is the winner. But anything above 400, so let's say even 405, I'm sure that here, as you can see, even on a move up to 405, which for a stock like Boeing is not a big move, but certainly is what I would consider a bit of a recovery for this stock. So, you know, I think the stock is still a little touch and go as far as what the actual outcome will be of the whole debacle with the 737s. And, you know, do I think that this is going to recover? Possibly, but I still think there's a lot of downside risks. So, you know, in this particular case, one of the good things about trading the debit spread is that you do have a limited risk, or both strategy have limited risk, so it really doesn't matter so which one you choose. The question is really just how bullish are you on the stock? You know, if you think the stock's going to rally back up to 415, then, you know, clearly this debit spread will make you $4,100 versus only $1,700 on the credit spread. So this is, again, an illustrative example as to why the credit spread is not ideal when you expect a big move. When you expect a big move, trade the debit spread. You're going to have the same amount of risk for substantially more profit. I hope that answered your question here. JB is asking, POP is probability of making any profit or a max profit? It's the probability of any profit at expiration is what the probability of profit means. Dan is asking, on the Boeing trade, do you make adjustments or ladder up or down depending on price action? No, we do not. We do not make any adjustments. We simply either close it at a loss or close it at a profit. Where can I get a manual explaining all the features? So the manual is actually right on your screen. If you click on the guide button on your platform, it'll bring up all these little flags. So if you want to understand what something is, you can just move your mouse over, and if you don't want to know what the options play score, everything is context sensitive. So as you move around, you're able to utilize these guide flags to let you know what something is. And you just click on the guide button at the very bottom to enable or disable that. Larry's saying, I had to enter my info before entering promo code. Yeah, I believe you have to do that. Can you go over your technical signal a bit? There's not much to go over other than the fact that it's, what we're using is we're using RSI to determine when something is extremely oversold. It is a proprietary signal to us that we've built in-house, that we've back-tested over pretty much every single stock since 1999 to generate these signals. We put a lot of computation into trying to find these highly unusual events that identify extremely overbought that have a high probability of reversing higher. And that's really kind of what we're incorporating into the credit spread signals that we're providing in this StockTwits room. John is saying, how do you decide when to use a single call or put? So John, I guess that depends on whether you're selling a single call or put or if you're buying a single call or put, because those are two very different strategies. So if you don't mind clarifying, I'm happy to answer that question. Wayne is asking, what's the promo code? The promo code is OPS20OFF, which I just typed again into the chat window if you want the promo code to the credit spread trading room. For BA, are you selling the 382.5 and buying the 382.5? No, we're selling the 382.5. We're always going to buy a lower put for Boeing. So we're always going to sell the at the money, which is the 382.5, and we're going to buy back at 367.5 here in this particular case. James is saying, not sure if I missed your answer as Amazon Prime was at my door, but I'm a subscriber to Chaikin. Is Options Play Signals included in that? No. So Options Play Signals is a completely separate service to Chaikin Analytics. Tony's asking, your chart is set up with RSI and what? I'm not sure what you mean by that, Tony. What are your parameters for RSI? We use a standard 14-period RSI. We don't like to, I'm a very classic technical analysis guy. I like to keep things really, really simple. For those of you that have ever watched my technical analysis webinars, I like to keep things really simple. I don't believe in using multiple indicators. Price action is my primary indicator that I use. If anything, I use horizontal support resistance lines when they're necessary. Otherwise, we use a very standard RSI on our trading strategies. We don't feel that there's a need to complicate things by using crazy indicators or crazy periods. Just using the standard technical indicators, but using the same ones day in and day out is far more important to us than using all types of crazy signals. Greg is saying, I just got here. Will the recording be available? Greg, like every single week, every single webinar that we do, the recordings will be available. And as long as you're registered, you'll get an email with it about 30 minutes after we finish here today. Wayne's asking, is Options Play Signals available through Merrill Edge? It is not. So Merrill Edge is a completely separate standalone platform. If you want to subscribe to Options Play Signals, you have to do that separately. Shalom, do you want to indicate on your screen how much money you need to cover the transaction? So yes, we always tell you how much money is required to cover every single transaction. So for example here, let's just go back to today, yesterday's Wells Fargo trade. So you needed 92 cents per contract because you're on every single credit spread. The max risk is the margin requirement to sell a credit spread. So here it's $92 per contract. So I highly recommend for those of you that are selling credit spreads to please watch the webinar on managing your risk and money management of options trading. I highly recommend those of you that are trading credit spreads to take a look at this webinar. I'll send a link to this in the trading strategy as well in the chat window because that helps you understand how to position correctly for your credit spreads. Alan saying, thanks, Tony. Good presentation. I'll register for the 7-day trial and have it go. Thank you, Alan. Good luck. Keith is saying, let's see. Let me close this out. Richard saying, I got into StockTwits. Where do I turn on alerts? Great question. So automatically you will get email alerts once you're subscribed to our room. If you want the phone alerts, you just have to download the StockTwits app in order to get phone alerts on your phone. Christopher, I will see you in Vegas next week. I'm doing a presentation for the Dorsey Wright folks. So if you're going to that conference, I will see you there. Let's see, this looks like there's a lot more questions here. Why not use weekly options? Fred, we do use weekly options. We use all options equally. We don't discriminate. This webinar being recorded? Yes, all of our webinars are recorded and you will receive the recording after we finish. Do you see earning seasons, the cash volatility? So the thing is that, yes, you do get a slight edge in volatility during earning season, but in my opinion, you lose that right off, because now you have all this directional moving. And these are fairly directional sensitive because as long as the stock moves a little bit against you, you're going to lose substantially more than what you collect on income. So yes, even though you have the slight volatility advantage during earnings season, you have a huge disadvantage because you have this huge delta risk. So I usually think that you don't really necessarily come out ahead just because of earnings season, in my opinion. Will the analytics be available on Chaikin? So no, Chaikin is a separate service, so you will not get any of these services through Chaikin. I receive options play in StockTwits. Do I need to subscribe separately to your YouTube channel for all webinar replays? You don't have to subscribe to YouTube, just that if you do subscribe to us on YouTube, you do get them immediately after we finish, but we always send you an email anyway. So if you get those emails, then you don't need to subscribe to us on YouTube. Is there a program to select all of your services together? So currently there is not. So currently the StockTwits service is a separate service. We are looking into potentially having a bundled service in the future, but for now it is a separate service for now. Gerald is saying, I had to leave my computer for a few minutes. Would you please review the 7-day trial and then subscribing? Sure. So what it is a pretty straightforward offer. You can go to this link here on your screen, which I will send one more time in the chat window. You can put in the discount code OPS20OFF. That will allow you to sign up for our credit spread trading signal, get a 7-day free trial, and a 20% discount off the $39 a month rate for the first 3 months of your subscription. And this allows you to try it out. POP is the probability of making any profit or probability of max profit. So again, POP is the probability of any profit. Wayne is asking, which alerts come out first? They come out at the same time. So we use StockTwits to distribute these signals, and you'll get the email and the phone notification at the same time. So no, it will not work for landline. The phone is a phone notification, so you have to have the StockTwits app downloaded on your phone for either iPhone or Android, and you will get notifications. The discount membership right now, the discount code is good for 3 months. So you'll get the first 3 months at 20% off. I didn't put the promo code when I first signed up. Shalom, if you don't mind, send me an email at info@optionsplay.com and I'll see what I can do about applying a promo code to an existing subscription. How often are you out with 50% profits? Is it like 80% of the time? I would say that 80% of the take profits that we have are early because like I said, what we have is these high probability signals, and what we're getting is that we typically see this large move in a very short amount of time. So like that Boeing example, we sold it on March 27th. We bought it back on April 1st. So the whole trade lasted less than a week. So, that is very typical of the strategies that we see. So as you can see, Hess here opened it on April 5th, closed it out on April 22nd. So that was about 2 weeks or so. Those are the types of scenarios that you typically come across. Mario, I'm already subscribed and was asked to pay more than the current offer. I'm not sure what you mean by that, Mario. We've never increased our prices. Tony's asking, so if you're bullish heading into an earnings event, are you then going to choose a debit spread and options play score typically above what? So yes, if I'm going into earnings, if I'm bullish and I expect there's going to be a large move, you should definitely buy a debit spread. Because part of the reason for doing so is because the risk that you have on a debit spread is substantially smaller than your potential reward if you're right on that earnings play, right? So in my opinion, on an earnings play, you probably have close to a 50-50 shot of calling it correctly. And what I prefer is that in the 50% chance that I call it correctly, that I have a huge amount of upside versus on a credit spread, and that 50% I'm wrong, I have a huge amount of downside. And that's why when you're going into earnings, why debit spreads, in my opinion, give you a slight edge versus selling credit spreads. Amir saying, I just subscribed. Do I need to subscribe to the different services in the room to receive your trade signals? I'm not sure what services you're referring to, Amir. There's only one room and it just gets you access to our signals. There's no additional services. So if you're subscribed to the options play signals room, there's nothing else you need to do. How many trades do you average per month? So we average about 3 to 4 trades a week, I think is a better way for me to explain that. Mitch is saying, how do I navigate to your reporting package? Mitch, I put a link in the chat window for those of you that want to take a look at the trades. So here I will send it again. Mitch, just look at the chat window and I sent you the links again there. Bullish call debit spreads, when to close ideally. So this is something that we covered in our webinar last week. So I highly recommend you to watch that recording. But generally speaking, on any debit spread, you want to cut your losses at 50%. You want to start taking profits at around 75% gains. Bill is saying, hold on. Mario, what should I do if I'm subscribed but not getting the daily email? So send me an email at info@optionsplay.com, which I just put again into the chat window if you're having problems with your subscription. And Bill, not sure what you mean by email kickback. Are you sure you sent us an email at info@optionsplay.com? That is a valid email address. Any other questions regarding credit spreads or the services that we provide? Tony's, you are no doubt the best I have found. Thank you so much, having tried many. But the rest of my question was, and the options play score. So as far as options play score goes, the goal of the options play score is to simply avoid ones that are red. So basically anything above 80 is either average risk reward or above average risk reward. And anything that's red is below average risk reward. So it's really just avoiding the red ones is a general rule of thumb that I have with the options play score. If it's yellow or if it's green, then it's good to go. Raymond, thank you so much. I really appreciate it. PD, same thing. Thank you so much. I really appreciate it. Wayne, again, thank you so much. Any other questions? James is asking, would you buy an option with the premium received for selling a credit spread? Not sure if that strategy has a name. It actually does have a sort of. There's variations of those types of strategies. We typically call them risk reversals. So yes, James, if let's say you want to sell a credit spread to fund buying a call option, certainly that's something you should consider, right? So I can sell this credit spread on Boeing for $1,700, or let's change this to one contract. I can sell this put credit spread on Boeing for $570, and I can take that and I can maybe buy a out of the money call. As you can see, it doesn't quite equate, right? Because here it's buying a June call, as you can see, cost me $1,700, but it can certainly pay for a portion of that call. So yes, there are plenty of option traders that do this type of strategy where they're selling out of the money calls or puts to fund. Typically what you're doing is you're selling an out of the money put to fund buying a call option to the upside. Synthetic stock works the same way. You're effectively selling a put to buy a call. There's lots of strategies that are a variation of this type of strategy, but yes, there are plenty of strategies where you would do that. And that's really a strategy where the calls are super expensive, like Boeing right now. These calls are pretty expensive. So one of the ways to offset the cost of such an expensive call is to sell some premium to the downside. Nicholas is asking, what is our year-to-date return? So we have published those returns on that document. Like I said, we launched this during Q4 of last year, which was not an ideal time to launch any type of trading service. And we have changed our algorithms and improved them as we've gone along. So I encourage you to take a look at those trades and see the improvements that we've actually have had over the last couple of quarters. So I encourage you to take a look at that document, which is in that chat window. That's called the risk reversal. Yes. So there are lots of different strategies that are variations of a risk reversal. There's risk reversal call spreads. There's finance verticals. There's vertical spreads. There's lots of different variations where you're selling premium to pay for a premium that you want to purchase. James, thank you so much. I appreciate it. Any other questions? John, we do not have a phone number for customer service. One of the reasons that we keep our price point as low as possible is so that we do everything digitally. So you can submit all your questions to us through this questions ask us button here on the upper right-hand corner, and we get back to you as quickly as possible. Bill just said awesome service. Thank you so much, Bill. So that is the best way to get in touch with us. It allows you to ask your question immediately, even attach a screenshot, and we can get back to you as quickly as possible there. Christopher, here's the link to the historical results for you to take a look at. Any other questions? Great webinar again. Thank you. Thank you so much. I really appreciate it. I hope you guys find this information useful. I hope this illustrates the fundamental difference between trading credit spreads and debit spreads. I know that there's a lot of questions as to where, whether credit or debit spreads should be compared to each other. In reality, they should not. There's a question about NQX, and that is a data issue that we are aware of, and we're looking to fix that as soon as possible. We actually have a new data provider that gives us indexing data. NQX is just one of those funny indices that we're currently not getting updated data for. So that is something we are looking to correct. Thank you for pointing that out. Any other questions? If not, everyone, like I said, thank you so much for taking the time out this afternoon. This webinar is recorded so that you will receive the recording with the offer link for those of you that want to take more time to research this before you sign up. We'll include both the offer link and the discount code so that you can sign up at your own speed after you've reviewed the webinar and the presentation. And looks like there's one last question here. Do you plan a webinar on iron condors? The answer to that is no. And the reason for this is because an iron condor is really just a call credit spread and a put credit spread on the same one, on the same trade. So that's like saying that I'm bullish and I'm bearish on the stock at the same time. And from my perspective, there was really never a time where I'm both bullish and bearish on an underlying stock. So that's why I don't fundamentally believe in trading an iron condor. Now, can you sell a put credit spread and the stock rallies a few days and sell a call credit spread and make an iron condor? Absolutely. But I don't necessarily believe in entering an iron condor as a sole strategy on itself, because there really isn't a time where I'm ever saying that I'm both bullish and bearish on a stock at the same time. There's no indicators that I've looked at that really tell me that, which is why I don't fundamentally believe in an iron condor. I believe it's one of those strategies that brokerage firms make a lot of money when you execute iron condors, but I don't really believe that it's a strategy that's really suitable for most users. James is asking, when is your next webinar? Great question, James. Actually, we're not going to be here next week. It'll be the week after. So I'm taking a week off because I'm traveling. I'm speaking at a few conferences, but the week after we will be back here. I believe that will be the 9th or the 10th of May. Is our next webinar. So we usually do them every single week, but next week I'm unfortunately not going to be here. So with that, I just want to conclude this webinar. Like I said, I will send out the recording to everyone with the slides and the offer and discount code so that you can review this at your own speed. Tony's asking, will you be at the Money Show in Vegas? I believe I am, which I believe is usually in November, October-November timeframe. If it is, I'm looking to be there. I can't guarantee it, but I'm usually there in Vegas every year. So I hope to see you guys all there. But I will be at the Traders Expo or the Money Show in Chicago in July for those of you that are in Chicago. So hopefully to see all you guys there. Thank you so much. And I appreciate everyone taking the time out here this afternoon, and look out for the recording in about 30 minutes. And I will see you guys in 2 weeks' time. Have a great evening.